I'm on mute, sir. You can start, sir.
So, hello everyone. Hope you all are doing well. Today, we celebrate the completion of a decade of our flagship scheme, Mirae Asset Emerging Blue Chip Fund. 10 years may seem a short period, but we've seen unprecedented volatility in markets. In the last 10 years, we've seen emerging blue chip blossom from a bud to a full grown flower. I want to share few details on the 10-year journey of Emerging Blue Chip Fund. The fund AUM has grown from 23 crores at the time of NFO to more than 10,000 crores as we speak. So it's been a phenomenal growth in AUM because of partners like you and investors who've given their trust to us. In the same period, the folios have grown from 4,000 folios to 9.1 lakh folios. The fund's 10-year CAGR return has been 17.8%, with the NAV growing from rupees 10 to more than rupees 50 during this period. And I'm talking about the regular plan growth option. And all of you can go to our fact sheet and check the returns of the fund across various cycles. And the fund has been able to beat its benchmark by a handsome amount during this period. I have with me a person who needs no introduction, Mr. Neelesh Surana, CIO of our AMC. Neelesh Surana has been associated with our organization since its inception and has been managing the Emerging Blue Chip Fund since its inception 10 years back. He is ably assisted by Mr. Ankit Jain and the equity research team in managing the Mirae Asset Emerging Blue Chip Fund. So welcome Neelesh on this Facebook and YouTube live session. So Neelesh, I have chosen 10 questions on the 10-year journey of Mirae Asset Emerging Blue Chip Fund. So let me start very quickly without wasting any further time. So my first question to you is, let's start with the background of the scheme. And the fund has completed 10 years. So how has the 10-year journey been of the fund? And you can share some light on that.
Yeah, thanks Weber for the introduction and good day to everyone. Before I give perspective on the Emerging Blue Chip Fund and on markets, our thoughts are first with the well-being of all the investors. Hope everyone is safe. So over the last 10 years, there has been unprecedented focus on macroeconomic parameters, both on domestic front and global related. So at various point in time, there were plenty of reasons to be skeptical on the prospects of skeptical on the prospects of the Indian equity. I mean, these included events starting from the aftermath of global financial crisis, the Eurozone crisis. We had a period of policy paralysis where there was oil shock, there were 2 elections, there was taper tantrum, Brexit, demonetization, and various related to growth, uncertainties related to growth, interest rates, inflation. And now we have the COVID-19 pandemic, which brings us another crisis of an unprecedented scale. Yet, as you mentioned in the opening remarks, the fund has been literally 5x in 10 years. And our optimism remains, our resolute faith on equity and the India growth prospects remain. And the crux or the main reason for this optimism is based on the investment philosophy that a good investment, when you're investing in a particular right set of business on a bottom-up basis, will deliver superior earnings growth despite macroeconomic volatility. So despite the headwinds, if the business is decent, then over time, returns will be in sync with the earnings growth and they have the capability to deliver a decent sort of earnings growth. So that optimism sort of remains. That said, the returns in equities are a bit volatile. If I were to give the journey of Emerging Blue Chip, I mean, returns have been lumpy. I mean, when it was launched in July of 2010, markets were not good. And for the first 3 years, the NAV moved by, say, about 20% And the next 3 years, which is around July 2013 to July 2016, it moves by almost 200%. So 10 became 12 and 12 became 35, 36. So that only highlights two things. One is the volatility and the importance to take a longer term view on equities. Say equity is asset class for longer term, particularly mid caps, would have volatility, and the only way to combat volatility is A, give a longer term time frame, and B, invest in quality business. So I think these are the core learnings of this journey.
Okay. So Nilesh, my second question is that, like you shared that, over the last 10 years, we've gone through very tough times. So what has helped Mirae Asset Emerging Blue Chip Fund build such a successful track record? Can you share what were the insights of the 10-year journey on that?
Yeah, so the overall approach has been there's been a disciplined approach to investing. I think that's the most important thing, which is to buy quality business up to a reasonable price. I mean, that has been the key point which has delivered satisfactory return. And the focus is more on, as I mentioned, on stock selection, on more on bottom-up idea, which is buy a good company. And I would say there are two parts in terms of the two aspects of investment decision. And very quickly to touch on that, one is on the stock selection and second is on the portfolio construction. So on stock selection, one of our investment philosophy has been centered around participating in high quality businesses run by able management and at a reasonable valuation and hold them for an extended period of time. So analysis of all three bucket, business, management, valuation, is sort of important from a risk reward perspective. On the second aspects in terms of portfolio construct, I think there has to be discipline, there has to be adequate diversification. Both are equally important. So the idea is to construct a diversified portfolio which could handle mistakes and yet deliver decent risk-adjusted returns.
Okay. So Nilesh, I liked, the name of the fund, that, emerging blue chip fund. So, how do you identify the emerging blue chip companies? Can you share the investment thought process and framework that you've been following, and what has been the evolution of, the entire framework over the last decade?
Yeah, so I already mentioned, briefly touched on the stock selection. See, what is important is quality and scalability of businesses help company evolve over time. Only when growth is high, maybe because of the size of opportunity or the longevity of growth, and if it is coupled with decent management and good return on investment, ROI, the term which we use, I think companies grow big. And that's what we see, that the pool of profit increase. And what happens is, if you buy that company a bit early, there are two levers, two horses which are pulling the cart. One is earnings growth, and second is generally it is accompanied by, in our observation, by PE expansion. So price is nothing but the earnings into the multiple. And if both happen, that's when we see a delta or a sort of multi-bagger sort of wealth creation. I mean, if I look at in this fund over the last 10 years, there were about, say, two names which were mid-sized companies moving to literally nifty companies. And there were multiple names which has moved from small mid-size to top 100 companies over a 10-year journey. They have migrated from a small cap to mid-cap to larger mid-cap to large cap to giant cap. That has been the sort of journey. So while obviously there have been few mistakes, some mean, but the common theme about emerging blue chip is that if you participate in growth, quality of growth with decent management, and as the size of profit increases, I think those companies do well, irrespective of macro headwinds or tailwinds.
Okay. So, Nilesh, I'm sure all participants would like to know that, what has actually contributed to the performance of the fund. Is it driven by, selection in few stocks or few sectors, or, by taking concentrated bets? So can you share on, what has worked in, those respective stocks or stock selection process?
Yeah. So wherever we follow a very diversified sort of approach, so there is no concentration of a particular stock, style, or theme. And as we dissect, let's say, the past return, I think we have generated returns over the benchmark by being in the right pockets, more on stock selection. What we have observed is there is divergence across sectors and divergence within a sector among a lot of stocks within a sector. And that divergence is quite significant. So the overall performance is much more dispersed in nature. We do not take large bets on a particular stock, and instead we try to construct a diversified approach and it's more granular and multiple stocks contributing to the returns.
Okay. So Nilesh, over the last 10 years, what would you see have been your most rewarding bets or your most rewarding investments? Like you mentioned, some of them moving to from mid cap to giant cap. So without naming the stocks or anything, but if you can mention what have been the rewarding investments and how did you identify those businesses?
Sure. So as I mentioned, it's very difficult to single out one over a 10-year period because there were multiple sort of stocks. But there have been cases where on a bottom-up basis within a sector, a company has displaced the sector leader. Case in point is a battery company where the challenger has become, it did literally challenge the leader and the stock moved up by almost 25, 30 times. We bought a chemical sort of company much earlier, almost 8-9 years back. That's about 20x. And in addition, I think the rewarding investment, apart from some of the compounding sort of businesses, is also that we have not shied away from taking contrarian opportunities. See, what happens is good business always go through a bad patch. So when the near term is impaired, near term is hazy, but the longer term is intact, that gives a very interesting opportunity in terms of price being in favor. And there have been various cases, whether it is auto company or a oil marketing company, on many of the pharma names, where we have seen that they were not doing well when we were buying it, but the company had the fundamental pillars to revert back to the normalcy. And that's where we see a good contrarian bet sort of playing out.
Okay. So Nilesh, you've been managing emerging blue chip funds since its inception. Now you have Mr. Ankit join, who's assisting you and managing along with you since January 2019. Because fund management is a fiduciary role where you manage people's money, we want to understand from you overall the team process that is involved while how you work as a team, and as well as the softer aspects on how Mirae Asset investment team goes along and manages people's money.
Sure. So as you rightly said, this is a sort of important fiduciary responsibility. It's a very competitive line, and there is always a pressure to generate superior performance, both vis-a-vis the benchmarks, the markets, as well as peers. And the pressure to get it right consistently is sort of intense and as well as exciting. I think the key thing to achieve this is to have a very well-defined process and set of processes, in fact. So we have an 11-member investment team, and the focus is on research. We have a head of research, and we have a sectoral analyst, and a lot of processes to help take investment decisions in sync with the analyst. I think that's the most important thing. As you rightly mentioned, that this responsibility of fund management, the task to assume trusteeships of investors' wealth and compound it over time is immensely satisfying. So, and given that you are dealing about the trusteeship of clients' money, it calls for that the team has very high standards of sincerity, following the processes, and obviously the integrity.
Okay. So, this is a question which I'm sure a lot of market participants always ask, and, I'm sure you would be able to share more lights, is that, why do you believe SIP is one of the best ways of making investments and for long-term wealth creation? And, what is your thought on keeping only the SIP or the STP option open for the emerging blue chip and, not having lump sum flows in it?
Sure. So SIP is basically a tool which allows for averaging investment cost. And the fundamental mantra behind rupee cost averaging is that you get more units when the markets are sort of lower for the same value invested. So it's a good averaging tool. And particularly when markets are volatile, I think it makes a lot of sense. And also, this product has almost 50% investment in mid caps. Mid caps by nature are volatile. I gave an example that first 3 years the returns were muted, next year were significantly higher, 20% and 200%. So, when you have those sort of volatilities and uncertainty, just like the period which we are going through, I think SIP helps mitigate the risk and to participate in the market. Additional benefit of SIP is you can synchronize your future stream of income by committing in a very well-defined manner in SIP. Coming to your question on emerging blue chip taking only the SIP, I think that decision was taken sometime in October 2016 That times mid caps were moving up significantly and we wanted to grade the inflows. Subsequently, the fund moved to a large and mid cap category, and we have maintained the thing because that when the decision was taken, I think the AUM was around 3,500. Today it is 10,000. We are getting good inflows with these SIPs, good long-term commitment by a set of investors. You mentioned the number of folios. So the SIP book is north of 200 odd crores. So I think all in all, we consider that we are getting good graded money, which is in very sync with the nature of the product. Which has a portion of investment in mid caps, which by nature are volatile. So we don't want to disturb that thing. That's the reason it is not open for a lump sum, and we are continuing with the decision which we have taken earlier in the interest of the investors.
Okay. So, Neelesh, market has seen a fair amount of volatility in the last 3-4 months. From
Yes.
touching a peak of 42,000 to 26,000, now rebounding very smartly to 36,000. I'm sure a lot of investors have this question that how should they invest in the market, and what would you say be the investment strategy that investors need to follow in such a market?
Yeah, so just to recap the background, we are going through this pandemic, COVID-19, and let me just sort of recap some of the macro parameters. And COVID is obviously the single biggest healthcare scare-related economic crisis the world has seen since the Spanish flu, 1918. And unlike other crises, this pandemic has impacted both demand side and supply side of the economy. And as a response, there is what we have seen is that there has been accelerated response in terms of policy easing globally and also fiscal loosening. Globally, about $5-6 trillion has been committed each by central banks and the government. So that massive policy easing provide impetus to growth and sort of asset prices. In India also, we have seen RBI reduce the rates by almost 200 basis points. We are at 15-year low interest rate. Repo rate is 4%. And just one tool before I come to the markets, see, interest rate is a very important lever in terms of when you look at the equities. It has multiple benefits. I'm talking of a scenario when virus sort of stabilizes. It improves the demand because there are a lot of rate sensitives. The EMIs come down. So rate sensitivity like housing and autos, the demand is a function of the interest rates. So that is the first point. Second is obviously you have a better cash flow conversion for the same EBITDA because of the same debt is repriced at lower cost. Third is also the fact that ultimately when we value any asset, including equities, what is a PE? PE also is a bit of inverse of interest rate, of course, with growth and ROE. So the point is that with lower interest rate, the discount rates come down and the multiple also sort of expand, other assumptions remaining the same. So that's one point. And very quickly to recap other macro points is we are seeing positives and negatives now. On the positive side, there is the economic situation is good for the country. Forex reserves are $500 billion plus for the first, and there is a benefit of oil price coming. So we will be having literally current account surplus after 16, 17 years. And the government is gaining on the oil side. And of course, there are challenges related to virus. On the valuations, I think while you mentioned that markets were down 40% and then they moved up by equivalent amount, year to date, we are still down by about 10-12%, depending on the indices. So it's not that from pre-COVID, it was not a very expensive zone because the economy was recovering. It was not doing well. We were not doing well FY20 pre-COVID. GDP growth, the profit to GDP was at 15-year low. So markets are down, first of all, 10-12% from that level. Second is also one basic factor, it's a long answer, but the fact is this pandemic is impacted, let's say, few quarters, 1 year, 1.5 years of cash flow. So when you do a valuation of a stock and you do a DCF, then 1 year cash flow doesn't impact the value by more than say 5-10%, whereas the price fall was 40-50%. So the intrinsic value change is less than what is the price sort of collapse was earlier. So to that extent, this rally has not come as much as a surprise, particularly when the interest rates have come down. And generally markets are, I think, say in the reasonable zone. The panic was more initial because of the unknown, the March and FI selling. So I think while there are challenges of the economy, we'll have a GDP degrowth after 40 years, all those things are there, but rural is doing reasonably well. Interest rate, as I said, is a bigger lever, and reforms would sort of help give the stability. So overall, I would say that while the pandemic, the virus is going to dictate the timetable of the normalcy, and thus the estimates are contingent on the duration and the intensity of the pandemic. But as things stabilize, we believe that because the valuations are reasonable, I think interest rate, rural stability, and reforms will help market consolidate and give returns in the longer term.
Okay. So Nilesh, like you mentioned, the last 10 years have been, quite challenging period with a lot of events that had happened in the last 10 years. I know it's a very tough question and, you need to be a fortune teller, but what do you think the next 10 years hold for markets? And do you think markets will be more rewarding in the next 10 years than they were in the previous 10 years?
Sure. So, Weber, one is like what we mentioned, that while 10 years have been challenging, you can see the absolute returns have been reasonably okay despite the challenges. And we yet to see a good environment of back-to-back GDP growth, etc. I think let's recap. If you're taking a 10-year view, let's look at the longer-term drivers to the growth. In a world which is devoid of growth, India remains a market which has the longer-term core drivers which will grow the economy at a decent pace, not this year, but over a period of time. And this includes favorable demographics, the rising aspiration level, the need for infrastructure. I mean, this is the basic pillar of sort of growth driver, which will remain for significantly long period of time. Basically, if you look at the entire consumption side from a 10,000 feet view or longer term view, it's very, very exciting. I mean, India's consumption appetite is literally unstoppable from a longer term perspective. I mean, the consumer market is about $1.5 trillion. It can go 4x over a decade and a half. That's significant. There'll be almost 100 crore people, a billion people added to the workforce in a decade's time in the working age population of 15 to 65, which is largest in the world. And the median age will remain favorable for next 3 decades. So I think the demographics are very favorable, and we have the potential in the infrastructure. Interest rates are expected to remain low for longer. That's an added positive. And the macroeconomic parameters are fairly balanced, and there are maybe positives, negative, but there are stability in terms of the currency. Reforms are to are is work in progress. And also, lastly, is while we would have missed the manufacturing opportunity in the past, there lies an opportunity now with the shift in supply chain from China, where if we can capitalize on that. So all in all, I think we do believe that the longer term opportunity is pretty solid, and post this stability in this virus and this situation, particularly with interest rates reform, I think we would assume, being an optimist, that next 10 years should be much better than the past 10 years, which has seen huge volatility on macroeconomic parameters.
Sure. So, quite an optimistic view, Nilesh. So, I want to ask the 10th question before we open it for our audience here. Is that, can you share the best advice that you would have received from someone, and maybe coupled with it, maybe any advice that you would like to share with investors?
Yeah, so I mean, among the various quotes and from learned sort of investors, I particularly like a quote from Benjamin Graham. I mean, it mentions that investments are most intelligent when it is most business-like. And Buffett one mentioned that these are the 9 powerful words ever written in the history of investment. So it may look a very simple statement, but I think it summarizes the key aspects of investment. A simple advice that when you're comparing valuation or looking at listed equity, look at it as a full owner of business. And that helps retain the conviction, particularly in irrational markets. And today we are seeing, let's say, some of the examples of that let's say we have some of the deals which are happening in the unlisted space compared to the same businesses which are in the listed, whether it is telecom, whether it is general insurance. We've seen few deals happening during the COVID, and you see the difference in the valuation. That shows that the listed space is relatively cheap.
Okay. So, thanks, Nilesh, for, your very, very insightful replies and a very insightful discussion. Now, I would request our participants to, post in their questions. We will try and take few selective questions from our participants today. Just before we take some questions, I only want to highlight few things is that, a lot of things have been discussed by Nilesh and myself. For, better disclosures and information, we would request all participants to go to our website, go through the offer documents of the fund, go to the fact sheet and check the performance of the fund so that they can make more informed decisions. So Nilesh, let me take some questions that have come from the audience, and we would request your replies on them. One question from Asmita is, which investment style would you prefer, the growth style or a value style of investing?
Yeah, so I would say that growth should be subset of value. So while we prefer a growth style, you have to, India is a growing market, you have to buy growing businesses. You should not start with a pure value approach where you buy something very cheap. So you have to buy good businesses, as I mentioned earlier, good management at a reasonable price. We cannot buy growth at any price. So while the approach is growth oriented, there is a limitation of the price which you pay. There has to be Lakshman Rekha sort of in terms of how much you can pay. You can't buy growth at any price.
Okay. So there is a question from Mehak. The question is, what is your favorite book? Maybe because you've been quoting Benjamin Graham and Warren Buffett. Maybe what is your favorite book and why?
Yeah, so on investments, I would say, the book by Phil Fisher, Common Stocks and Uncommon Profit. The book is simple to understand. It sort of instilled the rigor of research. And Fisher's main point is to look beyond the numbers while analyzing stock to understand the businesses. And I think the book is sort of born by his longevity, sheer longevity. It was published way back in 1958, and most of the thoughts are still so valid.
Okay. So one question was that, from Mr. Praveen is, if investors had to invest in equity funds, how many funds should they have, and what would be the allocation that you would give, say, between large cap, mid caps, or any thematic strategies? So how they should allocate across equity funds?
Yeah, so there are various advisors which sort of look into the individual asset profile and then suggest. But generally, I think one should have about 4-5 funds plus, but not more than 8-10 funds. Because and more importantly, the underlying fund should have different traits, whether it is large cap, mid cap, different fund managers, different fund houses. That is much more important. And in terms of the overall preference, we as a house have a preference towards large cap. We continue to have a preference towards large cap in the sense like one should have 2/3 to 3/4, about 70% towards large or multi-cap funds. And our preference towards large cap is due to their superior risk-adjusted returns, a decent growth profile, because India is a growing market, economy will grow at a particular size, large companies will benefit. And after such dislocations like what we have seen, whether it is demonetization, pandemic, a strong will become stronger. And larger franchises are generally better able to weather the challenges. So about 2/3 in large caps, 3/4 in in large or multi caps, and remaining should be in the mid cap funds.
Sure. So, one question is from Mr. Raja Mohan. He's saying for a retail investors to ensure that capital is not lost, how long they should be invested, say, in a lump sum or an SIP mode. And, if they hold any investments for more than 5 years, do you think market, volatility goes down?
Yeah, absolutely. So in equities, any time frame below 3 years should not be looked at. Any commitment of money which you have for the next 3 years should not be put, because in equities are volatile, as I mentioned earlier. And second point is one should also not look at point-to-point return. If you look at a point-to-point return in March of this year compared to a 10-year return, it may look very different, and sometimes the other way sort of helping. But over time, I think 3-year to 5-year as a minimum period is a good period to sort of invest in equities.
Sure. So there is one question from Mr. Vikram, and the question is, that like you mentioned that you should be having a large part of your allocation to large caps. So the investor wants to know whether a large cap part of the emerging blue chip is on similar lines to Mirae large cap fund or Mirae focused fund, or how is it? Is it managed differently?
No, so first of all, the construct of, I think we didn't touch on this topic, and good this question has come, that emerging blue chip is in the large and mid cap category, which by definition is around 50% in each bucket plus or minus 10%. So the range is around 50 plus minus 10%, either large caps or mid caps. So it's a well-defined multi-cap category. I think it's an underappreciated category. It is one of the beautiful category where a single investor, instead of writing 2 checks on large and mid cap, as a fund house can have best of the both large cap and mid cap in this sort of categories.
Okay.
So as regards to the question on how it is different from a large cap fund, the large cap fund is 80% plus top 100 companies. In case of emerging blue chip fund, it is, as I said, 50 to 60% top 100 companies. So there is more dose of mid cap in that. That's one. Second is we have different style, different managers. So that would have a bit of difference there. And the benchmarks are different. In the large cap fund, the benchmark is top 100. In this fund, the benchmark is top 250 companies.
Okay. So I know it's a side question, but I thought it's a very good question. So I am asking you, is a question from Mr. Arman is, what would have been your biggest learnings in the last 10 years, which has helped shape your life? I know nothing relating to maybe investments, but if you can share some insight.
Maybe I'll stick to investment only. Maybe. So it's basically, and I don't want to on an individual basis, but more as a team, there is a constant learning, obviously. And I think when we do mistakes, there are two types of mistakes. One is on stock selection and portfolio construct is the second bucket. See, on the first stock selection, you can have either error of omission, error of commission. I mean, either you buy a wrong business, that is a mistake, or if you ignore a good business, that's also a mistake. So it's also a constant learning, and the entire team I mentioned, there is an 11-member team. We always try to analyze the past errors which we could have done, and we try to fine-tune the processes to not to mitigate the mistakes. So in investment, stock market investing, it's very important that you jot down the mistakes, because the type of mistakes are not many. There are only 8-10 types of mistakes. It's important that when you don't commit the same mistake again. So
Absolutely.
We have to learn from the past mistakes. And on portfolio construction, as I mentioned earlier, I think idea is not to we should have a diversified approach so that no mistake can pull down the performance significantly, be it a stock, a style, or a theme.
Sure. So Neelesh, we'll just take a couple of more questions because the list of questions is a lot. And I think so a lot of people want to take your perspectives. So question from Mr. Sunil Javeri is that current rally is more liquidity driven and polarizing markets, both same in US as well as in India. How long do you think this can sustain? And do you think that there'll be a correction in the markets because it's liquidity driven?
So in part, it is true that it is liquidity driven, but the point is the fall was also liquidity driven. If you look at in March, I think FIIs collectively in fixed income and equities sold about $17 billion. There was huge selling. So the fall was equally sort of sharp, driven by the liquidity. And as I said, we should not look at only the rally. We should look at the fall also, and look at the YTD number. We are still down 10-12%. So partially it is true that easy money is there. But there is also a fundamental reset. As I said, this fundamental reset of large liquidity and interest rates being low will percolate into multiple ways in terms of stabilizing the economy and looking at various sort of asset class.
Sure. So I have got few questions, Neelesh, that they were saying that the AMC doesn't have a small cap or value funds or multi-cap funds. So maybe if you can share some sites on why Mirae Asset believes to have a small concentrated basket rather than having all the offerings.
Sure. So we have a portfolio of 9 funds. There are 5 equity diversified fund, 2 sectoral fund, 2 hybrid products. So that way the bouquet of offering is fairly complete. And generally we prefer small. We don't prefer small and micro caps and tiny caps because these are companies which are very, very small. The risk is higher. And as I mentioned earlier, that if the character of the business and the company, the scale of profitability is high, even it doesn't make a difference if you buy it when it is tiny or small, but rather even if you buy it mid-size, it can go up to a large cap. So the journey to create wealth is always there. Risk profile is less. So that's the reason we have a mid-cap fund. We have a separate mid-cap fund. So that's but we don't intend to, as a house, launch a tiny or a micro cap sort of fund. Internally also, even when we were small, as you mentioned initially, even when the emerging blue chip was a 23 crore portfolio, we had an internal benchmark that we don't look at a business which has less than 100 crore of cash flow. So that gives some stability. Let's say dislocation like this, small companies are very significant disadvantage. So that's on the small cap sort of side. Apart from, in terms of multi-cap, we have funds. We have the focus fund is actually a multi-cap fund. If you look at it, even emerging blue chip, you take 50-60% large cap, so it's not essentially a mid cap fund. I mean, we have a separate mid cap fund. We have a tax saver in the ELSS category, which gives the discipline of investing for 3 years. That's again a multi cap fund. So, and by the way, the difference between multi cap and large cap is limited to 5-10%. So I think, and plus obviously one can always have a combination. Let's say our large cap fund plus mid cap fund can be a good combination of a multi cap product.
Sure. And just Nilesh, one last question from Mr. Nasruddin is, that, like you mentioned, SIP investing is one of the best ways of investing. So he wants just some perspective on long-term SIP investing and how long they should remain invested on the equity market side.
So I think if you look at the historical returns of last 20-25 years of some well-established schemes and fund houses, you'll get the answer that over time, things do compound. I mean, last 10 years have been a bit unusual, where markets return have been slightly not in sync with even with the nominal GDP growth. But over time, equity returns, particularly in a growth market like India, should be in excess of the nominal GDP growth. And nominal GDP, I mean, will double the size of the economy in say about 7 odd years. So to that extent, ideally, one should not, I mean, SIP should be a core part of one's allocation, which should be there for literally perpetually, unless two things happen. Obviously, one is if markets are irrationally exuberant or are very high, then one can tactically reduce it. Or apart from that, if there is a rebalancing on portfolio or need of money, then one should sort of.
Sure. So, thanks for sharing your views, Nilesh. So my takeaway from this session is that as an investor, that you should remain invested for the long haul, and irrespective of the market noises and volatility that is there. I think that today's discussion actually reminds me of a quote, which, like you put down very rightly, is a famous quote from Warren Buffett, where he says, our favorite holding period is forever. So as we celebrate 10 years of our Mirae Asset Emerging Blue Chip Fund, I'm very happy to see the very active participation from everyone here. And I'll be happy to see many more investors and partners joining us when we celebrate the 20 years of this remarkable fund. So thank you everyone for your active participation in today's session. Hope you found this session interesting. We would definitely like to hear your feedback on this session. So please keep sharing your comments, and that will help us improve ourselves. And Nilesh, any last parting words from your side to everyone?
No, thanks, Vaibhav. Thanks, everyone. I would like to take this opportunity to thank all the investors for being part of this journey with the House of Mirae. And we hope you will be part of it for the years to come. Thank you very much.
So thank you, everyone, and hope to touch base with you very soon. Thanks.